Wall Street, home to the world's two largest stock exchanges, this iconic Manhattan address has come to symbolize corporate America and, in particular, the global financial services industry. There's a famous scene in Martin Scorsese's film The Wolf of Wall Street in which senior broker Mark Hebner explains to new recruit Jordan Belfort how stockbroking works over a lunch of martini and cocaine. The name of the game, Hebner says, is to move the money from your client's pocket into your pocket. Number one rule of Wall Street: I don't care if you're Warren Buffett or if you're Jimmy Buffett. Nobody knows if a stock is going to go up, down, sideways, or in circles, least of all stockbrokers. It's all a fugazi, it's a fake. Clients, Hebner goes on, are addicted to trading, and the challenge for the broker is to keep coming up with brilliant ideas to keep them trading again, and again. The client thinks he's getting rich, but in fact it's the broker who's taking home the cold, hard cash. Now, that description of how Wall Street works is of course designed to shock. It's out of a Hollywood movie. But in this film, we're going to discover how Hebner's description is in fact frighteningly close to reality. We're going to find out how, for many people, trading really is an addiction. How the fund industry continues to mislead the majority of investors into thinking that if only they can find the right stock, the right sector, or the right fund manager, they can consistently beat the market. Over the past 60 years and more, a vast amount of time, effort, and brain power has been expended on studying how people should invest for the future. With the help of investment author Mark Hebner, I'm going to present you with the findings and explain how education can replace speculation. You're going to learn how to build your own financial security rather than someone else's. You're going to learn how to invest and relax. One of the biggest reasons why investors fail to achieve their goals is that they aren't in fact investors at all. They're speculators, some you might call gamblers. Of course, the industry puts a more positive gloss on what most investors do. The term it prefers to use is active investing.
Active investing has to do with an investment strategy where an individual or a fund manager is trying to beat a market. I say a market because there are many different markets in this world: international, US, even bond markets. They try to engage in different strategies, such as picking stocks, trying to time the market, trying to select managers who will do one of those things and beat the market, and lastly, trying to choose an investment style that they think will have the best return at some near-term future. In essence, it's speculation versus investing. And it's actually a very bad idea because we have mountains of evidence that says that none of those things actually work.
The opposite of active investing is passive investing. Passive investors don't try to pick stocks, times, managers, or styles. Instead, they buy and hold globally diversified portfolios of passively managed funds. A passive fund or index fund can be defined as a mutual or exchange-traded fund with specific rules of construction that are adhered to regardless of market conditions. Equity index funds would include stocks of companies in particular geographical locations, for example the US, Europe or Far East Asia. Additional indexes within these markets include segments such as small value or large growth stocks. Securities are purchased and held within a fund when they meet that fund's specific parameters and sold when they move outside those parameters. Think of an index fund then as a rules-based investment vehicle. One of the advantages of passive investing when it's done properly is that it takes human emotions out of the equation. Emotions can have a very detrimental impact on investment returns.
Gambling generally has to do with a situation where there's a 50-50 bet of an outcome. It has to be close to an equal wager, or you wouldn't get two sides to the gamble. Those offering the bet, those taking the bet. The analogy for the stock market is we have fair prices which are achieved by millions of traders in publicly traded markets around the world. And those fair prices actually set up a scenario where it's an equal 50-50 bet as to what's going to happen in the very short term. This creates an action opportunity, which is the addictive component as described by Gamblers Anonymous. Now, Barclays actually did a study on this, and they determined over a 10-year period, those who let their emotions drive their investment decisions cost them about 20% of the possible return they could have earned over that 10-year period.
Experts in behavioural finance have identified a number of behavioural biases to which active investors are prone. One of the most common is overconfidence, expecting better returns than you're likely to achieve. Another is hindsight bias, thinking that past events were predictable when in fact at the time they weren't. And then there's regret avoidance, vowing never to repeat the same decision if it once resulted in a big loss or missing out on a significant gain. Behavioural biases such as these cause an investor to think they have an element of control in areas where actually they have little or none. Passive investors choose to stay invested all of the time, regardless of the market conditions, because they know that short-term volatility is unpredictable. To help them manage their risk, most of them rebalance their portfolios perhaps once or twice a year.
Rebalancing is sort of the antithesis of what the emotional investor would prefer to do. Most emotional investors think there's a trend from the past that will continue in the future. So if you started off with a 50-50 portfolio, and let's say your stocks went up, the active investor often thinks of that as a buying opportunity because something has gone up. But the rebalancer, or the unemotional, disciplined investor, says that that's an opportunity to get their portfolio back in balance, which means you actually sell some of that position that has gone up. And the same is true on the opposite. If your equities have gone down, the emotional active investor often thinks that's a signal they should be selling, but the disciplined, unemotional investor says, I need to buy more of those equities now to get back in balance. And that's actually a much better strategy because you've maintained your risk exposure.
Helping you control your emotions, keeping you invested during periods of market turbulence, and rebalancing your portfolio are all key responsibilities of a financial advisor. Yes, you could try to do it all yourself, but the chances are that if you do, you won't reap the full benefits of a passive, evidence-based approach. So, what are the benefits of emotion-free investing from a performance point of view? Dalbar conducts an annual study called the Quantitative Analysis of Investor Behaviour. Between 1998 and 2017, it calculates that the average equity fund investor who periodically bought and sold earned returns of 5.29%, while a buy and hold investment in the S&P 500 returned 7.2%. An investor who owned a globally diversified index portfolio would have seen returns of 9.04%. If you're still a little sceptical about the wisdom of passive investing, then why not listen to what the most famous active investor of all has to say on the subject? Yes, Warren Buffett is a staunch advocate of index funds. In his 2004 letter to shareholders in his firm, Berkshire Hathaway, Buffett said, "Over the past 35 years, American business has delivered terrific results. It should therefore have been easy for investors to earn juicy returns. All they had to do was piggyback corporate America in a diversified, low-expense way. An index fund they never touched would have done the job. Instead, many investors have had experiences ranging from mediocre to disastrous." In his 2014 letter to shareholders, Buffett said he had directed the trustee of his sizable inheritance to invest 10% in short-term government bonds and the 90% balance in an equity index fund. Not only then does Warren Buffett recommend passive investing for ordinary investors, When he dies, he wants his money to be invested passively as well.